I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. If you have over $125,000 of gross income per year, you may be subject to an additional tax you're not even aware of. That extra tax is called the net investment income tax, and I'm about to explain what it is. If you like this video, please be sure to subscribe to this channel and click the little thumbs up like button below. Thank you. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. The Net Investment Income Tax, or NIT, came into existence in 2013 as part of the government's Health Insurance Affordable Care Act, or ACA, program. Specifically, the additional revenue brought in by NIT is intended to help fund the ACA. NIT is an additional 3.8% tax that's applied on passive sources of investment income like dividends, interest, some annuities, certain rental income, and capital gains from selling investments. NIT only comes into play for persons whose incomes are over certain thresholds. First, let's discuss when NIT may apply. Specifically, NIT uses its own custom definition of Modified Adjusted Gross Income, or MAGI. It starts by taking your Adjusted Gross Income, or AGI, straight off your tax return, and then it makes you add back in certain exclusions and adjustments you may have made as a result of foreign income or investments you may have had. Now, practically speaking, most of you probably won't have any such foreign changes. With that said, your MAGI for purposes of NIT will likely just be equal to your AGI. Once you know your MAGI, then compare it against the NIT thresholds. If your MAGI is below your respective threshold, NIT won't apply for you. If you're married and file a joint return, NIT will apply if your MAGI is over $250,000. For married persons who file separate returns, the threshold is $125,000 per person. For single and head of household filers, it's $200,000. And finally, for qualifying widows or widowers, it's $250,000. So, assume your MAGI is over your threshold. Now what? Well, the net investment income tax is an additional 3.8% tax that is levied upon all your sources of passive investment income. NIT is calculated in your tax return by using Form 8960. Here you can see all the different sources of income that are subject to NIT. Things included are taxable interest, such as from bonds or bank accounts, ordinary dividends from stocks and mutual funds, annuities. Specifically, only non-qualified annuities are included. Income from annuities that are qualified or owned inside an IRA are not subject to NIT. Passive net income you receive from rentals, royalties, partnerships, S corporations, trusts, and so forth are also included. But the key thing to know here is that NIT only looks at passive forms of income from these things. As an example, if you are self-employed and that income comes from a partnership you own, that is not subject to NIT. But if you are a passive investor in a partnership, your net income from that partnership will be subject to NIT. The other big thing included in NIT is capital gains from selling investments or property. Yes, this means any net gains you have from selling stocks, bonds, mutual funds, and even investment properties like rental houses are subject to NIT. There are a few other items and adjustments included in NIT, but most of these things typically won't apply, so I won't get into their details here. It's important to know that NIT only applies to certain passive investment income, not all sources of income. For example, it does not apply to wages, unemployment compensation, Social Security, alimony, self-employment income, distributions from qualified retirement accounts, and Alaska permanent dividend funds. All said and done, you add up all forms of passive income you had for the year. Next, compare that to how much your MAGI is over the threshold. Whichever figure is less, that's the amount on which you'll have to pay NIT's additional 3.8% tax. Let's look at an example. Assume you're married and file a joint return and your MAGI is $260,000, which is $10,000 over the $250,000 NIT threshold. And assume you had $30,000 of total passive investment income. In this case, you'd only have to pay the 3.8% additional tax on $10,000. Not the entirety of your $30,000 of investment income. Before wrapping up, I wanted to share a few other thoughts I have and things to keep in mind with NIT. First, the MAGI thresholds are not indexed for inflation. That means that over time, more and more people will be subject to NIT as inflation occurs and people's incomes gradually increase. Even though incomes will be increasing, the NIT threshold will remain unchanged. While a $250,000 threshold for a married couple may seem fairly high today, it won't be so high in 5, 10, or 20 years. Next, anything that increases your AGI may potentially make you subject to NIT. Obviously, things like wages, Social Security, pensions, and IRA or tax-deferred employer retirement account distributions will increase your AGI. You may not be able to avoid such sources of income. But even voluntary things like Roth conversions or selling investments at a gain from your taxable brokerage account will increase your AGI. Therefore, Make sure you're aware of the potential impact NIT may have on you before doing any major conversions or investment sales. Also, keep in mind NIT only applies to passive investment income, like I said before. Just because you have a high AGI or MAGI doesn't mean NIT is going to come into play. For example, if your only source of income is $500,000 in wages, you're obviously over the NIT threshold. However, if you have no dividends, interest, rental income, capital gains, or so forth, there will be nothing on which NIT will apply, so this whole thing is a non-issue for you. But if you have a lot of capital gains, such as from selling a second home at a large gain from where you bought it, keep in mind that NIT will likely show up to the party and slap you with an additional 3.8% tax on that gain. Another thing to keep in mind is that NIT is a tax like any other form of tax on your return. With that said, if you're going to be subject to NIT, you want to make sure you have enough tax withheld during the year or make enough estimated payments throughout the year to account for having to pay NIT in addition to your normal income taxes. And finally, this video only mentioned NIT in the context of you and your individual tax return. However, NIT also applies to estates and trusts too. If you'd like to know more about the net investment income tax, check out the IRS's instructions to Form 8960 to read all the gory details of how NIT works. Or, for a more plain English explanation of things, the IRS has a nice webpage dedicated to the topic. It's aptly called Questions and Answered on the Net Investment Income Tax. You can find a link to that site in the notes to this video. Well, that's it. I hope you enjoyed this video. While an additional 3.8% tax on passive investment income won't necessarily break the bank, and it probably shouldn't drive your financial and tax planning decisions, it's nonetheless something to keep in mind and be aware of so that you're not taken by surprise when you do your tax return. If you haven't already, please be sure to like this video and subscribe to this channel. Also, subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. And be sure to join my free Facebook group, Taxes in Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.